All right, it's 12:02. I'm going to get started. All right. Hey, everyone. Great to see you here. Thanks for joining us. I'm looking forward to going through our bulletproof buyer strategy. I've gotten to discuss some of this or discuss this with some of our referral partners. Do me a favor, Alicia or Bill. Can you give me a thumbs up if you can hear me, see me, and see the presentation? Or Alicia, you can even holler over to me because I can't. All right, video is up. All right, cool. All right, I just let Gary and Billy. All right, so the objective of today's class, as we're entering, the final quarter of the year, we want to share some strategies with you that one will make you a better realtor and / consultant to your clients, and ultimately make you more money. So please ask any questions in the comment section. You can actually drop some in the Zoom chat as well. I've got Alicia from our team helping me monitor that. And I just don't want to skip over anything. There's a lot of info, and I want to, make sure we're covering it within an hour period. We don't want to go over. We want to be respectful to your time. So there's 3 challenges that we're going to cover today. And it's what we want to accomplish with kind of teaching you this bulletproof your buyer strategy. So the first thing that we're going to talk about, the first challenge, if you will, is the lack of supply. And there's just not enough inventory out there. That's not a Michigan thing. I know I've got mostly Michigan agents on here, but this is a national problem for us, right? For us, we're licensed in all 50 states, and we write loans in about 40 states. So we're seeing this as a national problem. Again, not just here in Michigan. The second challenge that we're going to talk about and figure out a solution for is we're in a position right now where we have our sellers that are essentially landlocked. They're maybe wanting to move, but they're not able to because they're worried about, okay, well, if I sell my home, am I going to be able to find a new home, right? And kind of what happened when we were putting this strategy together, and shout out to my coaches and mentors over at Tribe, Josh Meadow, Ryan Grant, Danny, Mark, all you guys that have helped, bring tremendous value to us, allowing us to bring this to our referral partners. But what we really found with that, this was also not only is it helping our buyers agents tremendously, it's also an ace in the hole for listing agents, right? Because the unique value proposition, if you will, for a listing agent has almost kind of been mitigated a little bit. And I say that because basically anybody can sell a house in 24 hours. So what we want to do is give you an additional unique value proposition to give you a leg up against your competition. And then the third challenge that we're going to solve for is the metric, and I haven't checked this since maybe April or May, but as of May, we were at 19% of all appraisals nationwide are coming in under value. So we need to solve for that problem. We don't wait until the client gets. Alicia, we got some background. Can you mute whoever that is? Thank you. So we don't want to solve for that problem in the middle of the transaction because that's when the fear kicks in and whatnot. So what we've done is upfront, we're educating clients on a strategy on if the appraisal were going to come in low. They're already educated, on a strategy of how they're going to navigate through that transaction, and also the psychology behind it. So they're prepared of why appraisals might come in low. So those are the 3 biggest things that we're going to cover for today. So again, any questions, feel free to pop in and either unmute yourself or drop it in either of the chats. So what are we dealing with, right? We have buyers who are scared. We have buyers who are tired. We have agents who are tired. I had a client that had come to us recently and put in, I want to say it was, somewhere north of 12 offers prior to getting connected with me and my realtor partner. And due to this strategy, we were able to get them into a home on the first offer that we put in together. And that's directly related to this strategy, right? They're endlessly searching and putting in multiple offers. Again, it's heartbreaking for everyone. Nobody wants to put in 15, 18 offers on a home and just keep being told no. So it's our job as realtors and lenders to change our strategies because the market is changing, and be as valuable as humanly possible to our clients, right? They're frustrated. They're looking to us, the pros, for answers and results, and not being able to provide them really just kind of causes that helpless, powerless feeling. So honestly, until now, until we've started implementing this on every transaction, we've started to really see an increase in the amount of offers that are winning. And before I jump to the next slide, if anybody would like a copy of this slide, because you may want to share this stuff with your clients, please either email me, mhajjar at afncorp.com, or you can just drop your email address in the comment or chat box, and myself or Leisha from my team will get that out for you. So what we're hearing from buyers is that they're scared, right? They feel like the market's moving too fast. They feel like we're rushing them. And the reason that they feel like that is because they haven't seen the data. We have to empower these clients with data, and which we're going to go through those slides to make their own decisions, right? And that's, obviously, they're not reliant on emotions, opinions, and conjecture at that point. And I'm going to, again, explain what this means. If I'm going too fast for anybody, stop me at any time. And I will take some questions at the end. So what do we need to do? We need to, one, give them the data. And two, they need to be prepared with a plan when the appraisal comes in low. We just talked about 19% of appraisals nationally are coming in low. But we need to be able to figure out what is that plan, and they need to be able to compete with an all cash offer, right? So, and you as our realtor partners, you shouldn't be doing all the work. This is a 50-50 split where we are your partner, right? As your lending partner, and we need to help you also educate your client and give you the information as well. I mean, I always get the question from, whether it be friends, family, new clients, whatever it may be. Well, hey, house prices back in 2006 were just as high as they are now. And then we saw house prices drop 10, 20, 30, 40, 50% in some markets, especially here in Michigan, right? But so they say, okay, well, isn't this just like 2006 and we're expecting another crash? And we're actually in the exact opposite market of 2006. So I'm going to go through some slides and some data that's going to be able to educate you, and then give you that info to educate your buyer. So right now we've got 4 fundamental pieces, and I've got a little bit of lag on my thing. So we've got 4 comprehensive pieces of what makes up part of this strategy, right? Or how we approach the strategy, rather. So one, upfront, we do a comprehensive analysis with every client, right? And I think, again, you're going to hear me talk about why. And the more informed your client is, the more educated they are, the better understanding they have of the housing market. When they know why the market is moving the way that it is, that's what is one of the things that eliminates fear. Number 2, we're going to talk to you guys about the appraisal gap strategy. So, and doing that up front, not waiting until mid-transaction to do that. Again, that's the reason, because we're going to look at it from how we deal with clients from not only a financial standpoint, we have to take their emotions into consideration as well. So we make sure upfront they're prepared, they have a plan, they also understand why do appraisals come in low. Number three, we're going to talk about this is more we are rolling this out in Michigan, but as of right now, I'm working on this with another financial company that American Financial and them. We're creating our own partnership, but we got to learn how to compete with cash offers. So I think it was the metric was 25% of all closings were cash offers. So we need to understand how we're going to compete with that, right? And part of that is with a fully underwritten, or sometimes you guys will hear me say a TBD loan approval. So we're removing all of those loan contingencies up front. And then, at that point, we're looking for appraisal and title. So when I'm sending over and I'm calling the listing agent to talk about the strength of the buyer, I'm also sending them the underwritten approval that shows there's no outstanding loan contingencies. Obviously, homeowners insurance, title, and appraisal, we wouldn't have that back yet until you have a house. But that's one of the ways. And we're going to talk to you guys a little bit about our home concierge product. That's going to be at the very end, again, for our Michigan clients. That's going to be more towards the end of the year, so I'm not going to spend too much time on that part. But it is interesting, and it is something that I want you guys to know about and be ready for when we roll it out. So let's start with why the housing market is moving like this. So I've got this graph, if it would pop up. Just give me a second here for it to roll over. So this is our year over year change in housing history, and we're going back all the way to 1977. So I want to look at this from a supply standpoint, and then I want to look at it from a demand standpoint. So let's start with supply. So if you can see my mouse here, if we were to draw a trend line, it's probably somewhere right here between the 1.5, 1.6 million, which was the average before the recession, right? But somewhere around 2006, we peaked at an all-time high. Builders went crazy with building, and obviously a lot of other things were part of the reason that we ran into the Great Recession. Builders collapsed, capital lines dried up. And then if you see this hole, this is the number of underbuilt homes. And this hole, and this is according to NAR. NAR's saying there's a 4 million too few homes built rather over the last decade, and we still have not filled that. So again, if we were to look back at the trend here of the 1.5, sorry, I've got this freezing on my screen. So if we're looking back at the trend on the 1.5, if we're looking here, we've never even rebounded back to really the average. So we're nowhere near supply in a situation of oversupply. We're trying to make up for this hole that was never filled. And we're going to get into that into some of the next slides. So all righty. So now we're going to look at number of single family housing units completed. And I'm going to go back to 1970 on this. And if anybody can't see my screen or anything, please let me know. But if you look here, I mean, we were, and I'll give you reasons on why each one of these is a year, right? So here's a different way to look at it. If we look from 2002 to 2006, well, the number of housing units completed, this was, I mean, if we look at the Great Recession, it caused the number to go to a historic low. Then 13 years straight, we were below the 50-year average going back to 1970. So that should give you another way of or let you know how insufficient the housing inventory is. Especially, I mean, we came here, we had this record-setting number of houses built, and then again, we're coming all the way through to now, and we're way below our 50-year average. So we're still talking supply here. So I'll give you another metric. Now, this is for homes that are sold nationwide. So this is going to be your year-over-year change in housing inventory. So if we go back to 2000, right, our trend line is somewhere between 2 and 2.5 millions of new homes built. But then we had starting about right here, right after the 25, we're going back into this 06 comment, where we had way too much building. There was 4 million homes for sale. That's almost double our average trend line, right? And now, if we look at that, we went from 4 million homes in 2006 down to 1.07 million in 2021. Now, that number might be 1.10 or 1.12 by now, but my point is, what we're saying is that there's one home for roughly every 330 Americans. So when a client tells me, okay, isn't this just like 2006? There's high prices, there must be a crash or a correction coming. And again, I go back to that, we're the exact opposite. We had 4 million homes for sale here. And we lead up to 2006 for the 4 biggest years of new construction. And then we went into the last 13 years where we were woefully underbuilt, right? So we use this sort of data to educate our clients. We use this sort of data to educate our clients on why 2006 and 2021, again, are completely differently. I'm still talking supply side. I'm going to get into the demand side. Once we get into the demand side of it, that's gonna go in conjunction with this. I'm sorry. All right, so we're still here on supply, and this chart, it always gets me. But again, if we look back at our trend line. Remember, we said we were somewhere right around the 2 to 2.5 million. Again, we're down to 1.07 million, right? Of home sales nationally. We're down 71% from here in 2007. So I'll show you what that looks like now on a map for us nationally. I've got my buddies in Utah who coached us on this strategy. So from April of 2020 versus April of 2021, they went down 68.1% in inventory. I mean, we're close right there in Michigan. We're at 59.4 in April 2020 versus April 2021. And obviously you can see this is happening everywhere else around the country. I think one of the other highest ones was Tennessee, South Carolina, and these are states that we do business in. So we deal with a lot these challenges everywhere. It's not like we're just dealing with here in Michigan. So again, we're still talking about supply is continuing to drop. And when we start talking about demand of the more and more home buyers that come into the market, it emphasizes how big of a problem this is. So here's another great one for clients to compare. In 2007, inventory was going up, right? And now we're on the exact opposite trend where everything is going down. And this is the monthly inventory of existing homes, single family homes for sale. But if we remember that slide where I said we had 13 years where builders couldn't, keep up with the demand or replenish their momentum since the recession, well, that shows us right here of why we had so many homes here and why this number is going to continue to drop. And it's the problem is not getting better, or it's getting worse every single year. And again, when we get into demand, this is going to be the demand side, right? So again, anybody stop me at any second if I went too fast on the supply side, but this is recorded, and I will be giving out the slide deck to our realtor partners. So again, so we covered supply. Let's talk about demand. Where are all these buyers coming from? And this is probably the most important slide that I'm going to show you throughout this presentation, but it's also the most technical. So I'm going to go slow through this one to make it to make sure I cover everything. So let's start all the way to the left here. So if we're looking back and we start with the 47 million, and that was the silent generation, right before the baby boomers. So if we went from the silent generation to baby boomers, it went from 47 million to 76 million. So what do we do with this birth data? We basically reverse engineer how many first-time home buyers will be entering the market. NAR states that the average first-time home buyer is 33. Well, this chart kind of tells us, okay, well, how many first-time home buyers do we really have entering the market? So we can look back at time and say, okay, well, what happened with the birth trends? Did they go up or down? That would forecast us to know how many first-time home buyers were there. So then let's look at what happened in 2006. Baby boomers had 76 million births in their generation. And that's roughly 4 million new. Each one of these stands for a year. I'm sorry, each one of these lines. So starting in, I don't know, what do you want to call this? 1951. We started to see a trend of 4 million births per year, and it started to go up. But what happened here? This line right here is 1973. Is there anybody that can tell me what happened in 1973? I wasn't born at this time, but thank you to my coaches and whatnot for helping me understand this. But does anybody know what happened in 1973 that caused Generation X birth rate to drop drastically? Open up. I can't see everybody. All right. Well, if we can't see that, then I'll just jump into it. So what happened in 1973 was Roe versus Wade. So this is when abortion was basically legalized, if you will. So we had a 5 or 6 year trough that had an impact on the birth rate from 1973 all the way to 1979. Well, that impacted the next generation of when these people would be 33 years old in 2006. And we're going to jump into that a little bit more into the next slide. But birth rates from are back to 4 million, right? From 1986 all the way until now. So 2006, we had way too much supply and a degradation in birth rate, right? But we also, today, we don't have the supply that we had. So we have an increasing birth rate, but our supply is going down. So this is where I keep pushing on the demand and supply, and how important it is to know that 2006 is nothing like 2021 and even going into 2022. Again, our supply problem is just getting worse at that point. So what's another reason that this is happening? So cash today, I believe a lot of it is coming from coastal relocation, and cash before was coming from the recession. It was coming from leverage. So before the recession, it came from leverage. Now it's coming from what we're seeing is, again, because we're licensed in throughout the country, is that we see a lot of this coastal relocation. A lot of our people moving from coastal states, whether they're going down south, whether they're coming here to Michigan, whether they're going to Tennessee, Florida, Texas, and Utah. My coaches are dealing with that all the time. But this graph is used to reflect, it's called a mortgage credit availability index, and this is from the Mortgage Bankers Association. But what the scores mean here, this 800 and 200 and 100, is this is how easy, basically the higher the score, the easier it was to get a mortgage. So if we're looking at June 2006, I was in the industry back then, and this 800 score here basically is telling us if you had a pulse in 2006 that you were going to get approved for a mortgage. We weren't so worried about credit. There was stated income loans. There was people that probably shouldn't have been put into homes, right? But it was way too easy of a loan. So now we fast forward to February 2021, and sorry, I just clicked through that screen. But if we're looking at February 2021, all the way at the right of the graph, well, that score is, just above 100. So we're in an incredibly tight credit market. We need assets. We need income qualification. Obviously, we have credit requirements. There's no more 500 stated 100% financing, which kind of led into the problems of the recession. So again, we're talking about the exact opposite market, where in 2006 anybody can get a loan, and in 2021, unless you're beyond qualified, you're not getting approved for a mortgage. So one way to look at this is, if you're looking at the red section, we talk about product risk, and if you look at the blue section, we're talking about client risk or borrower risk. So what is product risk? Product risk, especially for those of you that have been in the industry for a while, we know there was negative amortization loans where instead of your principal going down, your principal balance would go up because you were making a minimum payment. Well, that's probably one of the highest risk loans that there is out there. Well, guess what years most of those loans were written? Right here in this 05, 06, hence the fact 06 and 21 are not the same market. We had loans with prepayment penalties, adjustable rate mortgages, stated income loans, no income verification loans. So again, going back to that score of 800, it literally meant you have a pulse, you're going to get a loan. Well, if we're looking at, that's the product risk. Now, the borrower risk is, do they have the ability to repay the loan? Because if they're getting a loan and you've got a 500 credit score, and I'm not picking on anybody, I'm just using examples of loan products that were available at that time. Well, if you had a 500 score and you were financing 100% and you had no reserves, the lender who put you in that property had no right to do so. And that's malpractice in the way that we do business. But again, if we were to weave all of this together, again, we were talking about supply and demand. So if the supply side of the equation, which is extremely low, we have no inventory, we know that, and we take the demand side where the demographics are healing and they really look good for the next 20 years, because it's not just the millennials are turning 33, but then we have Gen Z who's now coming up and they're at that higher birth rate. Remember, if we look at that chart, and it's continuing to grow. And then we take the mortgage risk out of it, right? Again, it's way harder to get approved for a loan now. It's not cheap, easy credit. So what do we do? What do we do to get? What do we do to solve for this? And we're going to view that in the next slide. What happens when we weave all of those things together that I just talked to you about, with the supply, the demand, and removing the mortgage risk, anybody that's telling us that we're going to have a crash, another crash, here's a chart from CoreLogic. There's a bunch of other, professional sites you can get this from. I like this one, but this is the year-over-year change in home equity. I mean, look at Michigan. We're talking about every year we're a 15K appreciation rate, if not more. Let's look at states like Utah, 39K, California, 55K, right? So we're in a market where, again, somebody can tell you that we're going to have another crash because history says that we were going to have another crash. Well, that's not true when we look at all the data, we weave those things together, and that starts to cause that crazy appreciation. So here's a quote that I got from my buddy Josh Metal, and he sent it to me. It was from Goldman Sachs. But I want you to read what Goldman Sachs said. I actually have two quotes that sum up exactly what I believe is going to happen to this market. And I think this is great info to share with your customers. So I'm just going to go ahead and read it off to you. So strong demand for housing looks sustainable. Even before the pandemic, demographic tailwinds and historically low mortgage rates had pushed demand to high levels. Consumer surveys indicate that household buying intentions are now the highest in 20 years. As a result, the model projects double-digit price gains both this year and next. So a lot of times when a client will say, you know what, and I just had this conversation this morning, and it was a good friend of mine, and he said, Mike, you know, I feel like I'm wasting money with rent, you know, but I'm just worried about this crash and things like that, right? They might have people or friends or family that bought homes in 05, 06, and then lost everything, right? But again, without explaining to them that we're in a completely different market, there's no way for them to be educated enough to make a decision that's not based on fear, but rather a decision that's based off of education. And then the other quote he sent me was from Morgan Stanley, and I really like this one. So unlike 15 years ago, the euphoria in today's home prices comes down to the simple logic of supply and demand, right? And that's what I believe, right? Supply and demand rule. So, and we at Morgan Stanley conclude that this time the sector is on a sustainably sturdy foundation. This robust demand and highly challenged supply, along with tight mortgage lending standards, may continue, I have an issue with my camera here, to bode well for home prices. So higher interest rates and post-pandemic moves could likely slow the pace of appreciation, but the upward trajectory remains very much on course. So this education process is the most important thing that we can do as mortgage and real estate professionals. Explaining why 2006 is not 2021 and why the real estate market is doing what it's doing now. There's nothing more critical. Every time I spend 10, 15 minutes explaining all of this to a client, and that was that upfront sort of consultation that I mentioned in the beginning, they're no longer listening to, you know, maybe their uncle bought a house in 2006, lost everything, and is telling them, hey man, just wait, there's going to be another crash. But when I explain this to them, they say, what you're telling me is that supply is only continuing to go down. We're continuing to have an inventory problem. The demand is going up, which is going to cause house prices to go up even more. And it's like this light bulb goes off, right? It's the bingo. So for us, when you explain it that way, and you explain why, then there's no, I don't know what happened with my slides. But again, they're not moving off of fear-based decisions. They're basing their decisions off of what we've educated them on, the data, and we've shown them that, right? So that was part one, right? That was the first thing that we were going to talk about was solving for that challenge. Well, the second challenge that we had is appraisals. So again, I mentioned in the beginning, this is from CoreLogic, that 19% of homes came in basically below appraised value or contract price in April of 21. So that's more than double the percentage of the last two previous Aprils. So if we look at the bottom over there, we're looking at how appraisal issues impact sales. So they either delayed sales, right? Or they terminated sales. So in May of 2020, we had 18% of low appraisals impact or delay rather the contract or the contract date, and 6% were actually just completely terminated. Well, then look what happened in May of 2021. It's 26% delayed the transaction and more than double, right? So 13% terminated contracts. So if we realize supply isn't going to fix itself, because that fast it's not going to fix itself that fast, and especially demand's coming at us like a freight train, right? It's just, again, we looked at those birth rates, and I'll give you those things, but we have 4 million people on the brink of turning 33 years old. So this supply issue is not getting solved anytime soon. We don't have enough inventory. We don't have builders being able to build at what they're doing. And again, we've talked about sellers being in that place where they feel landlocked because they don't know if they sell their home if they're going to be able to buy a new one. So what do we need to do? We need to adapt. We need to create the appraisal gap strategy that we talked about. So we want to gap the bridge between sellers and real estate agents and appraisers, right? So the most weighted indicator, and I'm just reading off this first bullet point, the most weighted indicator of value is what a willing buyer and a willing seller agree the prices in an open market with ample marketing time. So it's not always, the appraised value is not always going to be the fair price, and I'm going to talk to you about why. We have here, so why are these appraisals coming in low? We have the speed that things are appreciating at, depending what market you're in. You know, some markets are 8% per year, some are 6% per year. So things are appreciating too fast. And the appraisers are not able to keep up. So an appraisal is a backwards looking tool because they're going 3, 4, 5, 6 months back to get sales. But if you're in a market that's appreciating at 1% per month, well, a comp from 6 months ago, it doesn't hold value to what the seller and the realtor believe that the property is worth. How many times, and realtors, lenders, how many times have you heard anybody say, oh, well, my neighbor just sold, 2 months ago for $425. I think I should be selling for $450. That's forward looking, right? And I agree with that based on appreciation rates. However, we know that because the appraisal is a backwards looking tool, that it may not come in at $450. So that's where the solution is, that the appraisal gap strategy comes in to basically come in the middle and bridge the gap between the seller and or the listing agent, right? The seller and the listing agent versus where the appraisal comes in at. And usually we find ourselves somewhere in the middle. So let me give you an appraisal of this. Here's a real life example. We've removed the client's name for privacy purposes, but this was a client who was maxed out. They could not come to closing with more than $175,000. That was their bottom line figure. But we had to figure out how we dealt with, if you're looking here, it was an $800,000 purchase price, putting 20% down. Well, the appraisal came in $75K low. But remember, I have that issue. I can't say, Mr. Client, you were going to bring 170. Now we got to bring in another 75. He doesn't have the other 75. So what we did was we increased the LTV, the loan to value, and we used a 1% upfront mortgage insurance premium. So what most clients don't know, and it's not their job to know, is that pricing above 80% loan to value, because if you see here, we came in at, it was an 88% loan to value. Well, there's something called loan level price adjustments, or LLPAs. So when you go above 80%, what happens is now you have mortgage insurance. The lender is actually protected more. So the pricing that you're going to get is going to actually be better. So we actually got half a point back that we were able to give back to the client. And because we added that PMI, right, the pricing got a little bit better. However, we took that 0.5%, we gave it back to the buyer, and then we took, it was, I think, $3,669 or $3,700. And we took that and we financed that into the loan. So now let's look at, and again, this probably doesn't make sense to a lot of people. So if I'm talking too fast, let me know. However, if you were to tell somebody, hey, your appraisal came in 75K low, most of them are going to say, oh, well, I guess I got a dead deal here. Or, you know, I guess I don't really know what to do. But what was the net effect of a 75K low appraisal? We had a $15.97. The payment is actually $15.97 higher on the 20% down. However, our cash to close is about $1,500 less. So I'm going to back that up one more time. Appraisal comes in 75K low. We bump the loan to value. So they're no longer using an 80% loan to value. They're going to an 88%. And we now have PMI, but we're not using it monthly. We did it upfront. We bought it out and we financed it into the loan amount. Even with doing that, our buyer still came with cash to close less. Now, let me tell you why this is critical, that this was done upfront with the client. If this is done after, if this is done mid-transaction, if this is done after the appraisal comes in, well, now you've got a client who is freaking out. You've got, you know, emotions flying. They don't care about what you're saying here. But when you do this upfront, if you're really advising your clients correctly, lenders, if you do this upfront, well, when the appraisal comes in 75K low, they already know what the impact is. You already told them, hey, doesn't matter if it comes in 75K low. And this is usually done in conjunction with the real estate agent, because we tell the agent, hey, you know, we did our comps as well. It looks like it's probably overpriced. We're going to come in and explain to the client. We're going to explain to the client what the impact is if it does come in low, so that way there's no surprises for them. And obviously they ended up closing, but this was a non-issue when it happened, because again, this was, all of it was addressed up front. Again, $16 payment difference, $1,500 less cash to close on a 75K short appraisal. So I'll give you another example. This is a $1.5 million loan, and they were maxed out at 300K cash to close. And that because we didn't want them to have to tap into their retirement or whatever it may be. However, this appraisal came in $150,000 low. So what did we do? Same concept as last time. Now, unfortunately, with jumbo, you cannot, there's no PMI. We can't add PMI to jumbo loans. But what we did was we bumped the loan to value from 80% to 90%, right? Again, because now our value is 1.35, and the cash to close was about 3K higher on this, and the payment difference was $404 a month higher. However, the client got the house, and that's what mattered. And again, this was not explained when the appraisal came in 150,000 short. This was explained upfront, because we didn't believe that the house was going to come in at 1.5 million. We just did our own internal research, kind of talked to the team and said, yeah, 1.5 doesn't look like it's going to go. I called the agent. I said, look, I've explained this to the client. We're not too concerned. We think it's going to come in somewhere around 1.4. However, if it does, our buyer knows exactly what is gonna happen. So there was no emotional fall apart when this did happen. So again, I can't stress how important this is to do up front and not do it after the appraisal comes in. All right, so that was challenge number 2, was the appraisal gap. So I want to move to the third challenge. How are we competing with cash offers? We just said earlier, 25% of homes nationally are being sold as cash. And I mean, you guys know, anybody in the industry knows. I mean, one of my buddies, I put his house up on a Friday and had 20 something offers in by Sunday, right? So you know, it's just a market where you're gonna go up against 5, 10, 15, 20 offers. This is the market that we're in. Again, we don't have enough homes. So a couple ways that we do this is the TBD process that we talked about earlier. So we're gonna completely pre-underwrite the file. So again, besides property, right, which we don't have yet, it's TBD, to be determined, title, appraisal, and homeowners insurance, we have everything else cleared. There's no concern that there's an issue with income, there's an issue with assets, there's an issue with that. We've already cleared all that, and we send that to the listing agent. But we can't do this for every client, and I'll tell you why. It's extremely expensive to do this process. So we created requirements. So one of the requirements is, are you basically active and are you ready to make an offer in the next 60 days? Because if not, then why do we need to, we don't need to TBD the file at that point. Because we have no idea when you're going to buy, right? Credit expires after 90 days. The second requirement is that you're ready to give us all of your documentation, not piece it, but you're ready to give us everything for a full underwriting approval. And then third, and I don't want to say this is the most important, but it is critical, is that, are we the right lending team for you and your family? The last thing we want to do is TBD the file, do all the work, put all the man and woman hours in there, and then you go under contract and start shopping us with your local bank or your local credit union or whoever that may be. And we're like, hey, we just told your listing agent we're closing in 14 days and the buyer's agent that we're closing in 14 days. We really don't have time for delays. So those are our 3 requirements for that. So another way to compete with all cash offers is American Financial Network. We're working on a partnership with a capital investment firm, right? And what this firm will do is probably, I mean, they've got 3 different products, but probably the most impactful one that I see. Remember, we talked about buyers or sellers being landlocked. Well, this allows them to go buy their new home within 10 days, and the company will buy it cash for them. Then they have 6 months to sell their home. So what happens is our partner will come in, they will buy the house with cash. Our buyer is able to move in immediately. And then once they sell their home, then they're buying the new home back from our partner with our financing. So the lenders, you guys don't lose out when a client does this. And realtors, this does not affect your commission. Your commissions are the exact same, whether a client were to use this or not. I'm not going to spend too much time on this because we're running out of time here. And this is not we are not set up in Michigan for this yet. We are working in other states on this, but it will eventually be rolled out in Michigan. And when that happens, I promise all of you agents that I will definitely do a class on just this. So, all right, now what did we do? Our clients, we just made them extremely more competitive, right? We're doing little minor things, sending videos to the listing agent, having them send it to the seller on why our buyer is the best. We're closing, quickly with the fully underwritten files, or, with our collateral partner who will go buy the house cash for them, right? But we can offer confidently up to max purchase price, compete with cash offers. Again, you're fully approved. You can remove your loan contingency with confidence because you already been through underwriting, right? So there's no loan contingencies there. We have an informed strategy. The client is prepared if the appraisal should come in low. And then, like I said, we do call the listing agent, before that. So I do want to back up to one slide. And while I'm doing that, does anybody have any questions here in regards to anything? Alicia, I can't see the Facebook chat, but I can see the Zoom chat. So, okay. Bear with me. I'm going to go back to our appraisal gap here. Okay. I just want to push again on the fact that the appraisers, again, an appraisal is a backwards looking tool. What the seller and the buyer, or what the seller and the realtor, how they value the home is a forward looking tool. Again, we're bridging that gap. We're upfront explaining to our clients, what does this mean? And really going into detail with this, right? Like, I mean, we'll go through this whole example with them and say, hey, we think it's going to come in 75K, but let me tell you why that is not a problem for you. So when you have a lending partner that can help you eliminate fear for your buyers, because honestly, why did 16% of homes get terminated? Maybe because the lenders didn't either understand this and didn't know how to explain it to the buyer, or I mean, the buyer just completely freaked out. Oh, I don't want to overpay. Oh, we're going to have another crash, and I already came in 75K low. But when you take all of the stuff that we talked about, supply, demand, removing mortgage risk, obviously implementing this appraisal gap strategy, doing the fully underwritten offers, you've got a buyer, and that's why we call it bulletproof, that again understands why the market is moving the way that it is, understands the trends of where it's headed, understands what it means if the appraisal comes in low, and how that impacts them. So if you're a professional and an advisor, and this is how you explain things to clients, you're not going to have 16% of your contracts get terminated. I'm not saying it'll never happen. What I'm saying is your client is not going to make that decision based off of fear. So what I'm going to do is I'm going to stop sharing my screen. I think I messed up the video participants, but I do just want to leave it open for any questions here in the last 5 minutes. If we don't have any questions, then I'll give you guys back about 4 minutes of your life here. And if you do want the slides, then we are, I can send those to you. Just send me an email, and let me get back to the slide where all my contact info is. Oops. All right, so here's my email, my cell phone number. For those of you that know me, you have it. But please feel free, reach out for the slides, call me with questions. This has honestly been a game changer for us. It's been a game changer for our referral partners. It's been a game changer for our customers, because everybody understands the why behind what we're doing. So again, please, thank you for joining. Thank you for any of your comments, your questions, and I look forward to hearing from you guys. I will be teaching this class again, so if you don't want to watch it on a recording, we'll let you know when the next either live event or Zoom or Facebook Live event is going to be, and we'll go from there. So thank you, everybody. Have an awesome day, and we'll give you that 3 minutes back. Thank you.